Welcome to the Alan Berry Reports TV show. I'm Alan Berry Laboucan. I'm the editor of the Alan Berry Reports and the host of this show. Thank you very much for joining us. If you look at the most talented investors over time, there's some common denominators that, or talents that they had, and those talents are related to their ability to see long-term trends before they're happening, and during that, while those are happening, they are good stock pickers, so they get in early and they ride those long-term trends for the long term. And this is what gives you above average returns. I see a lot, I spend a lot of time on the internet, I get a lot of emails, I get a lot of Twitter messages and Facebook messages, and I often see these pitches where they're offering these fabulous returns, or I even got one the other day where he says we're 100% accurate. When I see those kind of things, it just gives me a chuckle, and I just hope that people don't pay a lot of attention to those because it's a real serious way to lose a lot of money, in my opinion. And so, what does get good returns is above average returns is to be able to get into the right trends at the right time. And if you look over the last 10 years or so, the key trend or the key sector where you could find above average returns was in commodities and resource stocks. And prior to that, in the 1990s, the place to look for above average returns was really in the technology sector. Now, what created that situation in the technology sector, a lot of things sort of came together all at once. One of those issues was the Y2K issue. There was a lot of fear that because in the early days of computers, when you had mainframe computers and the first personal computers, memory was an expensive thing. So programmers tried to use as little amount of memory as they could. And one of the key things that they did when they had dates, they would only have 2 digits for the day, 2 digits for the month, and 2 digits for the year. Now, there was a big fear that when the year 2000 rolled around, the computers would all crash because they weren't able to see these 4 digits of the year 2000. And so there was, people were talking about airplanes falling out of the sky, that the banking system was going to come to a crash when the year 2000 rolled around. And a lot of it was just a lot of ridiculous hype, but one thing that did happen was a lot of those old computers were sort of refreshed, and if you look at a lot of people bought new computers, and then at the same time that this was all happening, the internet was really taking off. So you had sort of a perfect situation to develop where a lot of people were keyed on technology, they were focused on technology, there was a lot of reasons to be optimistic about technology, and so this is where a lot of funds were focused. Now, unfortunately, they got to an exuberant highs and ridiculous levels. Practically anything.com would go up and, would go from $0 to $100 like nothing. And those situations, when you get those speculative tops, they always turn out poorly. Now, if you look at the situation with the commodities and resource stocks in the past 10 years or so, why they performed very well is during the 1990s, when all this money was going into technology, not enough money was going into the ground to find new deposits of commodities that were being mined and taken out of the ground every year, and they weren't being replaced. And so at the same time that this underinvestment period was happening, you also had the economies of the developed economies growing rapidly, and then also the emerging economies growing rapidly. All this demand from developed and emerging economies put at the time when you had weakened supply chains is why we've had a long-term period of strong market for commodities and resource stocks. Now, why I think that this is going to be different than the 1990s is that currently the fundamental reasons, the weak supply chain and strong demand, are still in good condition, and there has not been one of these speculative run-ups in prices. And so a perfect example of that is one of the famous mutual fund managers. He recently tried to start a fund, and he put up his own $200 million, and all he was able to raise was an extra $90 million. Now, if there was a speculative run-up or the bubble of some sort, he would have been raising $1.5 billion like that. The fact that he was not even able to raise 50% of the money that he was putting up of his own money is a pretty good indication that we're not near any speculative excess. So based on those fundamentals of supply and demand and the lack of a speculative run-up, it still looks like commodities and resource stocks are the place to look for exceptional returns. And so in our reports over the last 5 years that we've been writing them, we talk a lot about trends, and these are long-term trends that we follow. Now, sometimes you can find short-term trends, and one of those short-term trends that I've been noticing lately is if you look at the American dollar, which has a lot of impact on the pricing of commodities because commodities are quoted and traded in the US dollar is the key currency. If you look at the US dollar, it's been under pressure for a over the long term. And lately it's had a bit of a rally. And during that rally, it's been we've seen it gain a little bit of strength, but that period of the rally inside this long-term bear market looks to be running its course, and we think that that's going to change around. Now, one thing that's been quite impressive during this period of the sort of short-term rally in the US dollar is that commodities have been, by and large, performing very well during this period. And so I think what we're about to see happen in the near term here is that the dollar will resume its long-term bearish trend, and commodities will have another run up in a long-term bull market. Those are some of the long-term trends that we think about and the short-term trends, and we talk a lot about those in our reports. Another area where we used to talk a lot about those is in our radio show. All of our past radio shows you can find on our website, and to navigate your way around those shows you can go to our blog, and we have a directory on there, and if you look back when the show was on, we also did little synopsis in the blog, so you can sort of navigate your way through the shows by using the blog. And on the website you can also find all of our past reports where we talk a lot about these trends. And so that's a wrap on today's commentary. Before closing, I'd like to stress that the show and the reports are for information purposes only. We aren't making buying or selling recommendations. It's important for you to do your own research and speak with your financial advisors before making any investment decisions. We're always trying to grow our audience, and if you'd like to help us, just look for the share button, and that will help you to be able to send our how to find our shows through Twitter, Facebook, or email. We really appreciate you taking the time to watch the show. We know that everybody's busy, and we try to provide a show that saves you time and gives you high quality information. As always, we hope you join us for future shows and visit us on our website at allenberryreports.com. Thank you for joining us. Have a great day.